A 937 price gap exists between two silver markets today. One metal, two prices, a 12.92% premium in Shanghai over COMEX. That spread has not closed for weeks. That does not happen in a balanced market. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, this gap is widening into the weekend with markets closed. Let's get straight into it. The silver market is sending a signal paper traders cannot ignore. Western spot closes Friday at 75.89. Session range sits 72.99 to 76.97. Shanghai Gold Exchange closes at 81.88. That is a 937 premium over 72.51 reference pricing. The data is not subtle, it is direct. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. Shanghai Gold Exchange physical pricing divergence. 81.888 per ounce physical silver. 75.89 COMEX paper silver. Plus earn 12.92% premium. Effective Friday close May 7. This follows 5 consecutive years of global silver deficits. This follows declining registered COMEX inventories. The unusual detail is persistence, not the gap, the duration of the gap. Arbitrage should have closed this within days. It has not closed for weeks. The timing is what deserves scrutiny, not the event itself. The timing. Think about what that sequence actually means. When a 13% arbitrage exists and does not close, supply is constrained somewhere. That constraint is physical metal. So the question becomes simple. Which market is mispriced right now? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. COMEX registered silver sits near 77 to 80 million ounces. Open interest sits near 550 to 575 million ounces. That is a coverage ratio near 13 to 14%. The stress threshold historically sits near 15%. That threshold has been broken for 6 consecutive months. The data is already telling you something. Let's build it out. Now let's build the full picture because the Shanghai premium does not exist in a vacuum. The World Silver Survey 2026 has dropped. Over 762 million ounces have been drawn from above-ground stocks across 5 years. Source: Silver Institute official report. The projected 2026 deficit is 46.3 million ounces. Source: Silver Institute. That marks 6 consecutive years of deficit. Annual consumption exceeds annual production every single year. That is not a one-off imbalance. That is a structural drain. Now add industrial demand. AI hyperscalers commit $715 billion in capital expenditure. Source: corporate filings from Meta, Alphabet, Microsoft, Amazon. That is up from $375 billion prior year, nearly double. Silver demand rises through semiconductors, power infrastructure, data centers. The rate of industrial pull is not slowing. It is accelerating. Now connect that back to inventories. COMEX cannot meet large-scale delivery without stress. The Shanghai premium confirms that stress is already visible in physical markets. The data is doing the talking. The ones who were dismissed for calling physical shortages, they are not saying much right now. And here is what makes that picture even harder to ignore. Global silver market runs 6 consecutive deficit years. Above-ground stocks decline by over 762 million ounces. At the same time, paper silver open interest expands toward 575 million ounces. That is not a contradiction. That is the setup. Physical supply shrinks. Paper claims expand. And before anyone takes that as a green light, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Now here is the number most people are not talking about. The dollar index drops below 98. Lowest level since late February. Source: ICE DXY data. That matters because silver is dollar priced globally. Now currency moves shift demand instantly. Now Iran negotiations enter the picture. Oil pricing reacts immediately to geopolitical risk. If oil moves above $125, inflation expectations rise. Bond yields react. The 10-year yield moves toward 4.5% in risk scenarios. Markets are still pricing partial stability. Look at the DXY at 98.22 and tell me what probability you assign to sustained dollar strength. When markets start pricing the reality of weaker dollar conditions, commodities reprice upward. Silver moves with that flow. Every time dollar weakness combines with supply constraint, metals respond. It has not been different yet. Now bring that back to silver specifically. A weaker dollar increases global purchasing power for physical silver. That expands demand precisely when supply is tight. Think about what that sequence actually means. Silver Western spot at 75.89, Shanghai physical at 81.88, 937 premium. That is the current price reality. Short-term picture is unstable into Monday open. Iran negotiations create binary outcomes. If Iran tensions resolve, oil drops. Yields fall below 4.2%. Dollar weakens under 97. Silver likely pushes toward $85 to $90. If Iran escalates, oil spikes above $125. Yields push toward 4.5%. Dollar rebounds toward 100. Silver could drop toward $65 to $66 support. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. This environment is headline-driven and unstable. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. Oil spike above $125 increases inflation pressure. Higher yields reduce metal attractiveness. Dollar strength toward 101 pressures commodities lower. The bull case is equally real. 6-year structural deficit removes supply cushion. Shanghai premium confirms physical tightness. Dollar weakness expands global demand base. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one conclusion. Physical markets are pricing scarcity. Paper markets are lagging that signal. The only question is when convergence happens. Don't take my word for it. Verify every number I gave you today. Check the data yourself. Silver Institute, Shanghai Gold Exchange, CME Group COMEX data. Logic over hype? Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0, out.